A financial market report is drawing significant attention to a set of conditions surrounding the upcoming Sunday evening Asian market opening scheduled for 6 o'clock Eastern Time. Curious. The report centers on the current state of the COMEX silver futures market, which concluded its Friday trading session with silver recorded at a closing price of $83.68 per ounce. Western futures exchanges, including the COMEX and the New York Mercantile Exchange, remain closed through the weekend, leaving that Friday closing price as the last recorded figure in the Western paper futures market. The report draws a distinction between the Western paper futures market, where trading is currently suspended, and the Eastern physical delivery markets, which are scheduled to resume operations Sunday evening. Specifically, the report identifies the Shanghai Gold Exchange as the first major market center to reopen following the weekend pause. The report characterizes the Shanghai Gold Exchange as a physical delivery market, noting that contracts traded on that exchange are backed by physical metal held in auditable vaults, and that contract holders are entitled to take physical delivery of the underlying metal. The report contrasts this structure with the COMEX futures market in New York, where the report states that paper contracts can be sold representing quantities of silver significantly exceeding the physical metal actually held in registered vaults. The report states that on the COMEX, short selling of metal not physically held is permitted within the rules of the exchange, and that synthetic supply can be created through paper contract issuance. The report further notes that this system functions without disruption as long as contract holders do not demand physical delivery of the underlying metal. The report outlines three primary factors it identifies as converging ahead of Sunday evening's market open. The first is what it describes as a physical arbitrage spread between the COMEX paper price and the price at which physical silver is currently changing hands in the physical market. The report states that silver eagles are currently trading at $89 at physical retail dealers, representing a significant premium above the $83.68 COMEX closing price. The second factor is a set of geopolitical developments that unfolded over the 48-hour weekend period, which the report states Eastern market participants have been monitoring and assessing. The third factor is the current structure of the COMEX silver futures market, which the report states shows registered silver inventory available for physical delivery at levels described as multi-year lows. The report also references specific supply and demand figures for the silver market, stating that industrial demand is currently consuming approximately 1.1 billion ounces of silver annually, while mine supply stands at approximately 950 million ounces per year, producing what the report characterizes as a structural annual deficit of 150 million ounces. Central to the report's analysis is the figure of $214 billion, described as China's current trade surplus representing net export earnings accumulated over a recent period. The report identifies this surplus as a source of capital that Chinese institutions may deploy into physical commodity markets when Asian trading resumes Sunday evening. Turning now to the specific geopolitical developments the report identifies as having unfolded over the 48-hour weekend period, the report outlines two primary events. It states Eastern market participants have been monitoring and incorporating into their commodity market assessments ahead of Sunday evening's trading session. The report presents these developments as directly relevant to the positioning it anticipates from Chinese institutional participants when the Shanghai Gold Exchange opens at 6 o'clock Eastern Time Sunday evening. The first development the report addresses is the United States government's purchase of sanctioned Russian crude oil. The report states that this action has exposed what it characterizes as a significant vulnerability in the United States energy supply position, noting that domestic production has proven insufficient to meet demand at current levels. The report frames this development as directly undermining what it describes as the prevailing public narrative surrounding American energy independence, and states that Eastern market participants have observed and assessed this development over the course of the weekend. The report further states that this energy situation has contributed to erosion of confidence in the United States dollar's standing as the global reserve currency. The second geopolitical development cited in the report is described as a diplomatic engagement in Paris, which the report states revealed what it characterizes as a weakened American diplomatic position. The report does not provide granular detail on the specific terms of the Paris discussions, but presents the outcome as a further signal to Eastern market participants regarding the current relative strength of the United States' negotiating position in international forums. The report frames both of these weekend developments, the Russian oil purchase and the Paris diplomatic engagement, as factors that Eastern institutional participants will incorporate into their market activity when Asian trading resumes Sunday evening. The report then transitions to a detailed explanation of the specific market mechanism it expects to activate at the 6 o'clock Eastern Time open. It describes this mechanism as a physical arbitrage trade, in which Eastern institutional participants simultaneously purchase silver through the electronic Globex futures market at the COMEX paper price, while demanding physical delivery through the Shanghai Gold Exchange. The report states that the price differential between the COMEX closing price of $83.68 and the physical market price currently reflected in dealer premiums creates an arbitrage opportunity that Eastern traders are expected to exploit immediately upon the Sunday evening open. The report illustrates this mechanism with a specific hypothetical scenario. It states that if the Shanghai Gold Exchange opens Sunday evening and immediately places bids for physical silver at $88, the resulting $4.32 gap relative to the COMEX Friday closing price would not materialize gradually. The report states that arbitrage algorithms operating in the electronic Globex market would be unable to permit a spread of that magnitude to persist for more than seconds, and that the electronic paper price would therefore be required to reprice instantaneously to match the Eastern physical demand level. The report characterizes this repricing as occurring through a teleportation of price rather than a gradual incremental move, meaning that no transactions would occur at intermediate price levels between $83.68 and the new level established by Eastern physical demand. The report identifies this absence of transactions at intermediate price levels as the defining characteristic of what it describes as a liquidity vacuum during the Sunday evening trading session. It states that the Sunday night Globex market operates with significantly reduced liquidity compared to the standard New York trading session, and that this reduced liquidity means that large buy orders from Eastern institutional participants encounter no offsetting sell orders at intermediate price levels, producing instantaneous and significant price gaps rather than gradual price movement. The report then connects this liquidity vacuum directly to the risk profile of Western hedge funds currently holding short silver positions. It presents a specific quantitative scenario involving a hedge fund that shorted 10,000 silver futures contracts at the Friday closing price of $83. The report states that each contract represents 5,000 ounces of silver, producing a total notional short exposure of 50 million ounces. It states that with a prime broker margin requirement of 10%, the hedge fund would have posted approximately $83 million in collateral to support this position at the Friday closing price. The report then calculates the effect of a Sunday evening gap up to $88 on this specific position. It states that a $5 upward price movement against a 50 million ounce short position produces $250 million in unrealized losses. It further states that the margin requirement on the position would increase from $83 million to $133 million, creating an immediate requirement for the hedge fund to post an additional $50 million in collateral within 60 minutes or face forced liquidation of the position by the prime broker. The report states that this margin call scenario becomes particularly acute on a Sunday evening because the hedge fund manager is not present at a trading terminal, wire transfer systems are unavailable due to banking hours, and clearing systems are offline during the weekend period. It states that in this environment, the prime broker has no mechanism available to it other than forced liquidation of the short position, which it executes by placing buy orders to cover the outstanding contracts. The report continues its analysis by describing the cascading sequence of market events it expects to follow the initial forced liquidation of short positions during Sunday evening's trading session. It states that when a prime broker executes a forced liquidation by placing buy orders to cover an outstanding short position, those buy orders add directly to the upward price pressure already being generated by Eastern physical buying demand. The report describes this as a self-reinforcing cycle in which rising prices trigger additional margin calls on other short position holders, whose subsequent forced liquidations generate further buy orders, which drive prices higher still, triggering yet another layer of margin calls and forced liquidations across the broader population of hedge funds holding short silver positions. The report refers to this cycle as a gamma flip and states that once this mechanism activates, it has the capacity to drive silver prices significantly higher within a compressed time frame before the New York trading session opens on Monday morning. It states specifically that this cascading liquidation process could take silver to $95 per ounce before New York traders come online Monday morning, based on the scale of short positioning it identifies in the COMEX silver futures market. To support this characterization of the cascading liquidation mechanism, the report cites a historical precedent from the nickel market. It references the 2021 nickel short squeeze on the London Metal Exchange, stating that in that instance prices gapped so violently that the exchange was required to cancel executed trades in order to prevent what the report describes as total systemic collapse. The report uses this historical event to illustrate that the forced liquidation cascade it describes is not a theoretical construct, but a documented market phenomenon with precedent in physical commodity futures markets. The report notes, however, that unlike the London Metal Exchange situation, the Shanghai Gold Exchange does not have a comparable mechanism to halt or cancel trading in the event of extreme price volatility. The report then addresses a second historical precedent it presents as relevant to Sunday evening's anticipated market dynamics. It references March of 2020, when the Federal Reserve announced unlimited quantitative easing on a Sunday evening. The report states that Asian markets opened first following that announcement, and that gold gapped up $70 in the first 2 hours of the Sunday night trading session. It states that by the time the New York market opened on Monday morning, the upward price move had already been fully executed and short sellers had already been liquidated, leaving New York traders in a position of chasing a price that had moved substantially during the overnight session. The report presents a second historical reference point from August of 2023, citing the BRICS summit at which the alliance announced its expansion to include Saudi Arabia and the United Arab Emirates. The report states that this announcement was made on a Saturday, and that when Asian markets opened the following Sunday night, the yuan strengthened against the dollar, and the Shanghai Gold Exchange recorded its highest single-day volume in its history, as Eastern central banks executed purchases ahead of the Monday New York Open. The report presents both of these historical instances as illustrating a consistent pattern in which significant geopolitical developments occurring over weekends are digested by Eastern market participants and expressed through aggressive Sunday night market activity before Western markets reopen. The report also provides a detailed minute-by-minute timeline of how it anticipates Sunday evening's market open will unfold, presenting this as a framework for market participants monitoring the session in real time. It states that at 6 o'clock Eastern Time, the Shanghai Gold Exchange opens and the electronic Globex silver futures market becomes the first venue for observable price movement. The report states that within the first 60 seconds, a volume spike of approximately 3 times the normal Sunday open volume would serve as confirmation that large institutional participants are executing physical arbitrage trades. It states that by 6:05 Eastern Time, a price movement of at least $2 from the Friday closing price would represent a bullish signal consistent with aggressive Eastern front-running activity. The report states that by 6:15 Eastern Time, the first wave of algorithmic stop-loss orders set by Western hedge funds to protect their short positions would begin to trigger. It characterizes these stop-loss orders as buy orders that, when triggered, add to the upward price pressure already being generated by Eastern physical demand and prime broker force liquidations. The report states that if the silver price is above $88 by 6:15 Eastern Time, it would indicate that the gamma flip mechanism has activated and that the upward price movement is likely to accelerate rather than stabilize. The report states that by 6:30 Eastern Time, prime brokers would begin issuing margin calls to hedge funds whose short positions have moved into deficit territory. It reiterates that hedge funds cannot meet margin calls on a Sunday evening due to the unavailability of wire transfer systems and banking infrastructure, leaving prime brokers with no option other than forced liquidation. The report states that by 7 o'clock Eastern Time, if the move develops as it anticipates, silver could be trading at $90 or above. It states that at this point, retail investor activity would begin to contribute additional demand as participants observing the price movement execute purchases, adding a further layer of buying pressure on top of the institutional covering activity already underway. The report states that by 8 o'clock Eastern Time, mainstream financial media coverage of the price movement would begin, but characterizes this timing as too late for most market participants to act upon, as the primary price movement would already have been completed and short positions already liquidated. The report states that Monday morning's New York session would open into a fundamentally different market structure, with the $83.68 Friday closing price having become what the report describes as ancient history and a new support level established somewhere in the high 80s based on the overnight repricing. The report also addresses the COMEX silver inventory situation in further detail, stating that COMEX registered silver inventory has declined from approximately 200 million ounces in 2020 to 60 million ounces at the current date. The report states that the SLV Silver Exchange Traded Fund has not taken delivery of new physical metal in several months, that the Perth Mint in Australia is rationing silver sales, that the United States Mint is operating under allocation programs, and that the Royal Canadian Mint is experiencing order delays. The report presents these supply indicators across multiple institutional and retail channels as collectively consistent with the physical shortage conditions it has described throughout its analysis. In its concluding section, the report turns to what it characterizes as the broader market implications of the Sunday evening price movement it has described, extending its analysis beyond the immediate silver futures market to address the potential cascading effects across the wider commodity complex. The report states that if the Asian market successfully reprices silver to $90 or above during Sunday evening's trading session, it anticipates a sequential repricing effect across other commodity markets. The report specifically identifies gold, platinum, and copper as markets it expects to follow silver higher in the period following Sunday evening's open, as investors assess the implications of a significant divergence between paper futures prices and physical delivery market prices in the silver market. The report frames this potential multi-commodity repricing as reflecting a broader erosion of confidence in the Western paper futures pricing system rather than a development specific to the silver market alone. It states that if the COMEX demonstrates an inability to deliver physical silver at the paper price, and if the London Bullion Market Association experiences conditions where the spread between paper and physical prices becomes too wide to arbitrage effectively, the resulting loss of confidence would extend to other commodity markets where similar structural characteristics exist between paper contract volumes and registered physical inventory levels. The report further states that retail investors observing these conditions would be expected to withdraw capital from commodity exchange traded funds and seek physical delivery, creating additional demand pressure on already constrained physical supply chains. The report then addresses the physical retail supply situation in further detail, stating that premiums at coin dealers and online silver retailers would be expected to escalate significantly from their current levels in response to the price dynamics it has described. It states that premiums, which the report notes are currently at approximately $6 over the COMEX spot price for silver eagles, would be expected to rise to $15 over spot and potentially $25 over spot as retail demand accelerates and physical inventory at the dealer level is drawn down. The report states that at some point in this process, physical price discovery would break down entirely due to the absence of available supply at any premium level, producing a condition where no transactable price exists, because no metal is available for purchase at retail. The report reiterates its characterization of the COMEX silver market structure as carrying significant systemic vulnerability, restating that the exchange claims approximately 900 million ounces of silver across its vault system, but that only 60 million of those ounces are registered as available for physical delivery against outstanding futures contracts. The report states that if even 10% of paper contract holders were to simultaneously demand physical settlement, the registered inventory would be insufficient to fulfill those demands, creating a delivery default scenario. The report identifies 3 specific data points it presents as the primary indicators for market participants monitoring Sunday evening's Asian Open in real time. The first is the volume of buy orders in the electronic Globex silver futures market within the first 60 seconds of the 6 o'clock Eastern Time Open, with a volume level of 3 times the normal Sunday Open, described as the threshold for confirmation of large institutional execution. The second indicator is the price level reached within the first 5 minutes of the session, with a move to $86 or $87 in the first 5 minutes characterized as an extremely bullish signal indicating aggressive Eastern front running. The third indicator is whether the silver price exceeds $88 by 6:15 Eastern Time, which the report states would confirm activation of the gamma flip mechanism and indicate that the upward price movement is likely to continue accelerating through the remainder of the evening session. The report closes its analysis by returning to the geopolitical framework it established at the outset. It states that the 2 primary weekend developments it identified, the United States government's purchase of sanctioned Russian crude oil and the diplomatic engagement in Paris, are being assessed by Eastern market participants not merely as isolated policy decisions but as indicators of the current trajectory of United States financial and geopolitical standing in the global order. The report states that China's $214 billion trade surplus represents the capital available for deployment into physical commodity markets when the Shanghai Gold Exchange opens Sunday evening, and frames the anticipated physical silver buying activity as an expression of a broader strategic reorientation by Eastern economic powers away from dollar-denominated financial instruments and toward physical commodity accumulation. The report concludes by stating that the Friday COMEX closing price of $83.68 per ounce represents the last recorded price in the Western paper futures market prior to the Sunday evening Asian Open, and that the physical market conditions, inventory levels, industrial demand figures, geopolitical developments, and arbitrage mechanics it has outlined collectively constitute the backdrop against which that price will be assessed when Eastern trading resumes. It states that COMEX registered silver inventory data will be published on Tuesday morning and will reflect any physical metal movements resulting from Sunday evening delivery demand activity, presenting that data release as the final confirmatory indicator of whether the market developments it has described materialized as anticipated. That concludes our complete coverage of this financial market report. The Shanghai Gold Exchange is scheduled to open at 6 o'clock Eastern Time Sunday evening. The electronic Globex silver futures market will be observable in real time through publicly available charting platforms from that time. COMEX registered silver inventory data will be published Tuesday morning. We will continue to monitor all relevant market developments and geopolitical data points and bring you updated coverage as new information becomes available. This has been your financial market briefing. Stay informed, stay verified, and we will see you in the next report.